Oxford family, Landon Randall, president of Oxford Retirement Estate Planning. Welcome by Tom Siomades. He's the chief market economist at 𝗀𝗄 Wealth Management. He was in town this week. Thought it would be a great opportunity to sit down with you, talk about the markets. Obviously, a lot going on with the recent sell-off and correction last week, then kind of bouncing up here the last couple days, negative. But a lot of clients, a lot of families concerned with the recent sell-off, and rightfully so. There's a lot going on with the new Trump administration, a lot of changes going on in D.C., tariff talks, correction. We just had our State of the Economy in January, where we had about 700 clients there at the Renaissance Hotel, and you've been a part of that before. And I said on stage, listen, we've had two back-to-back years of 20+% returns. We are due for a correction, which is a 10% sell-off. Well, that should be expected at any given time after the write-up that we've had. But want to kind of get your opinion about this specific correction. How deep do you think this goes? What would be some indicators that we're seeing improvement? There's been a lot of concern basically from the pandemic. A lot of Americans, a lot of people have gone to cash during the pandemic. They may have dipped back in and then got burned again in 22, and so they back off more. I know a lot of our families have a lot in cash, but they're not getting hurt in cash unlike previous years, because we were getting 5. Now we're getting 4% on cash. So lots of people, rightfully so, are comfortable sitting there getting 4. But from an investment standpoint, I'm like, well, when are we going to deploy that to get higher rates of return? Because we know rates are going to be coming down. Jerome Powell's talking right now. It doesn't sound like they're going to reduce rates. But at some point, probably later this year, especially if market continues to sell off, I would expect them to jump in, right? Or if recession talks, and start reducing rates to help counterbalance that. So just want to get your opinion and thoughts of where we're headed in this tumultuous time right now.
Sure. So you mentioned we had 2 really solid years, right? If we do nothing in the stock market this year, we're 0, right? We just end flat. The average 3-year return will be like in the high teens. Mm-hmm. Okay, so we've been really spoiled the past couple of years, right? Things have happened, and the market seems to just shake everything off and just keep heading up. Everything was, for the most part, super priced in with like perfection. Like everything had to be absolutely perfect for it to continue. We had a really good January because there was a lot of euphoria, right? New administration coming in, things are going to happen, and they did. There was a lot of stuff that went on. Unfortunately, some of the stuff that went on turned off some people. I don't know that necessarily, the tariff stuff caused this, but it was, a drop, a pebble in the serenity pool, right? And all of a sudden you get these ripple effects. So, if the market's already on the verge of being spooked because we've had these 2 great years, right? It wouldn't take much.
Right.
So this sell-off, like you said earlier, is natural. We generally get 2 5%ers a year and a 10%er. Okay, we just got the 10%er before we got the 5. Is it done? It's hard to say because the information that keeps coming out continues, to roil markets, right? So we don't know. But at the same time, though, when you think about it, none of the traditional things that would cause major corrections are in place. There wasn't really any kind of energy crunch. There's not a liquidity crunch. And then there's not some kind of bubble. Okay, all we are was like we've had a prolonged period of really good, calm performance. People got lulled. And then all of a sudden, somebody rang the gong and people scurried.
Right.
So that's kind of, to me, again, it's hard to call down, like down markets and say, okay, now we hit it last Friday. I don't know. It looks like we hit a level at 10 and then the market bounced back up. All of this stuff that's going on right now could easily be ending in a week. We don't know if the tariffs that are announced for April 2nd will go into effect. If they don't, the market's going to bounce back up, right? And it's like the underlying stuff is still mostly positive. It's just that there's just kind of like, a cloud on the horizon that these tariffs may cause inflation, may put us in. There's a lot of mays going on, and I think that's enough to scare people after they had the really good run they've had the past couple of years.
Well, and I'd say since the pandemic, with a lot of uncertainty, lots of people been in cash. And my conversation with my clients has always been, hey, if you're in cash and you're going to buy, I don't want to buy at all-time highs, right? I want to buy the dips, right? And so when we had the correction last week, we sent out an email. I told everyone we'll send out emails once we're in correction. That's an opportunity to buy. It doesn't mean you go all in at once at a 10% correction, right? But would you say now is a decent time, since we've had a correction, to start dollar cost averaging in maybe 15 to 20% of what you have liquid in cash, start buying in, pause maybe a little bit and see where things go? Because people are, as rates go down, they want to try to get a higher rate of return, and they're looking for opportunities to buy in. You got some of these great companies and Amazon and Apple that are down double digits. And if we're going to buy in, I'm probably not going to buy in to the more conservative bonds and stuff like that. We want to buy the equities that are going to give us the best growth while they're down.
Yeah, if you think back, and I know sometimes it's hard, right? Because people are so in the moment, right? And they don't look at it from a historical perspective. Like, what did the S&P go down to during the pandemic? Around 3,000, somewhere around there. I think it might have even gone a little. I mean,
we lost 33% in a month, right?
We were at 6,100 in January. So if you sat there from the time when you tossed your chips in at 3,000 or 3,200 or whatever, we can quibble about what the actual low was. Right. But let's say it was between 3 and 3.5. The thing practically doubled in that time period.
Right.
And while you're sitting there, kind of clutching, kind of fiddling around, clutching, kind of worrying about what's going to happen, you miss out on that, right? I mean, you look at an S&P 500 or any of the stock market, NASDAQ, whatever, any of the charts over the long term, it's jagged, right? Those little jigs and jags are downturns, and then but the constant momentum is upward and to the right.
Right.
So the question I would ask if you're sitting in cash is a simple one: do you think the stock market will be down 3 years from now?
Right.
And if you do, then you should stay in cash. But at the end of the day, when you consider the fact that markets are generally up 3 out of 4 times, right? 75% of the time the market's up, right? So, it's obviously a positive, kind of direction. Why would you not want to just say, hey, listen, let me just put a little bit back, like to your point. I love dollar cost averaging, right? I mean, it's just you do a little bit at a time. You can always stop. You always have the comfort of, your pile of cash just in case. And it works. But to me, you have to have some fundamental, answer some fundamental questions from the get-go.
Right.
Do you think the market is a forward-looking mechanism? Is it a loser's game? Because at 75% success rate, I don't think it's a loser's game. So, and then where do you think it's going to be 3 years from now? Do you think that the country is going to be in such a horrible place that the market will experience some sort of like 70s, directionless flat market? I don't.
Right. Well, and the truth is I don't know any clients that got to their life savings where they're at by being in cash this entire time. Most of them built it in the markets, but then got nervous around election cycles, pandemics, and back off and go to cash. And now you got to have kind of impeccable timing of getting back in, because it seems like every time you go to buy, it goes down. You know what I mean? It's just the reality of it, of investing. And that's why we tend to dollar cost average in. And you're right. The last correction was in fall of 23, but it was short-lived. It was like an inter-day, right? And people are like, well, I didn't hear from you. Well, it was an inter-day, and before you knew it, the thing popped right back. And then before that, in 22, we had the sell-off of about a 20% loss. That was the last good time. And you look at the numbers from both of those periods, we're up double digits, right? So that's why it's super important, guys, that if you are in cash, you got to communicate with us. We're never going to take your money and invest it just on our own and say, hey, we're going to put it in for you. That's not our role. It's got to be an open dialogue between you and your advisor of what your wishes are. And so please reach out to us. If you're in cash and thinking about buying, reach out to us. That's what we're here for, and we can talk about that, talk with your advisor about what we want to go into, and start getting some of this cash deployed for you.
Sorry. What's interesting is I was talking about this the other night, and I was kind of laughing about it. I don't know if it was just a function of age. You're a lot younger than I am, but it just seems that everything happens a lot quicker these days, right? Storms seem to be more violent, right? Market corrections, like this correction, 7th fastest in history.
Yeah.
But it could literally just turn around just as quickly, right? So you can't be fiddle-fuddling around, sitting on the fence, wondering whether, well, is this a good time to get in? I'll wait, it doesn't work that way because, remember we look at the financial crisis, 2008. Oh, every pundit came out. There was the same thing, right? Mm-hmm. It's going to take years for the market. It was back. Like that horrible, terrible market of March of 2009 was literally back 2 years later.
Right.
Okay. Same thing with COVID. Oh my God, this is the worst thing in the world. We recovered, but it was February, March. Mm-hmm. We recovered by August. Mm-hmm. So the opportunities are few and far between. One, two is, at the end of the day, when that pullback, like I just look at the market this morning, and before Powell got done talking, and it's like we're back to where we were kind of last July.
Yeah. Right.
That's how horrible is that? Because I think a lot of people were happy last July, right? And so to me, it's like if we go down to last July and then this thing turns around again and then goes up again, and then the next time it comes down, what's it going to come down to? January 2025 levels, which was an all-time high. People were happy then. But now we're going to be at 7,000 or 7,500. And then, because it seems like every time you pull out and park,
right,
the next run up takes you up higher, and then you're just looking there and saying, man, I should have not either gotten out or I should have gotten in and stayed.
It's true.
And market timing, we talked about this. You're well aware of this. Market timing is a horrible thing that we inflict on ourselves. We think we could pick tops. We think we could pick bottoms. We can't do either one well, right?
We're all guilty of it.
Let alone both, right?
Right?
And that's the problem, right? We think we're going to outsmart this thing, and we can't. So you got to let the system work in your favor.
Well, and I would say most of our clients are retirement age, and so they've got 30 to 50% of their money already invested in financial products that can't lose, whether they're using CDs, fixed annuities, or index annuities, and generating most of our clients their income from those assets. So, staying in cash on the sidelines can be hurtful long term, right? You miss out on this, and inflation. I think Jerome just said he expects that to tick up a little bit, right? So let's talk about it, though, because I think some of the concerns wrapped around market performance being so good on these bounce back is during the pandemic, Trump's administration turned on the printing presses and did quantitative easing with Jerome Powell, right? And then we did it the first year of Biden's presidency at $125 billion a month, right? Which created a lot of the inflation, which helped prop up the markets during the pandemic when everything was shut down. Well, that's done, and now the Fed's been tightening and they raised rates. What was weird to me is the Fed took rates from basically 0 to 5.5, and markets still went up. Like, I would say that's not a normal environment. Normally you would get some sort of a pullback, but is it just delayed and that's what we're getting now? Could you talk a little bit about, hey, is this market kind of artificial because of the propping with quantitative easing, and now that they're done, is that a concern?
Well, that's a valid point. I think if you can get 5% when you consider the fact 5 years ago you couldn't get anything,
right,
and it was a lot more stable, sure, that's probably a part of it. The other part of it is, frankly, there's a retrenchment in how things are working in the economy, right? They're trying to affect changes, right? This past economy, even though the market was going up, wasn't really great. The government was spending a ton of money. A lot of the jobs that were being created were government jobs. That's at risk. That model is at risk now because they're going in and trying to cut government spending and not increasing the size of government, right? Mm-hmm. At the same time, you've got a scenario where, rates are expected to stay. People say they're high. I think they're kind of normal. They've normalized. And I think what the market was doing, the market was okay, in my opinion, saying, hey, we're okay at short-term rates around 4%. Historically, that makes sense. And I think there was a lot of stuff going on with respect to growth in certain industries that are going to be transitory, right? Not transitory, transitional, right? You look at things like AI and things like that, and research and medicine and things like that. Those are going to transform the way our society is. You look at this thing, it's like, 20 years ago, I had a flip phone, right? And now you got a computer in your hand. All those things are forward-looking things. I think people may have gotten a little bit ahead of themselves, but do you really think that 5 years from now, we're not going to have flying cars and, well, maybe not flying cars, but, more advancements than we have right now.
Right.
So, I think that's what the market was kind of looking at. And then if we streamline the government, get rid of some of the regulations, lower energy cost, make it make the government and the economy more efficient. Yeah, I think that's what the market was kind of looking at. And now it's like, that's been sort of muddled a little bit. And that's kind of why I think we're seeing what we're seeing. But markets are smart. There's a reason why they go up 75% of the time. They figure it out. They're going to figure out the new playing field, and they're going to move on. And I think there's always going to be that opportunity. You mentioned a little bit earlier about people. So you were in the military, right? And they do a lot of things in the military to stress us out, right? To make, to see how stupid we can be under stress.
Right.
The problem is when you have and this affects people in their everyday. When you have stupid things going on, you lose like fine motor skills, right? You go on and off. Mm-hmm. What people need to understand and remember, not all of your stuff is in the stock market. So if it goes down 10%, your entire portfolio or didn't go down 10%. Right. You have an annuity, you got life insurance policies, you've got Social Security coming in, you got pension, whatever. Right. There's a bunch of stuff, but we get so caught up because every day we're bombarded with bad news, bad news, bad news, and you're looking at it and you're like, oh my God, the S&P is down 10%. But have you checked what your actual balance is? Right. And to me, if you're at the point, like I saw a story the other day that they said some couple, was considering selling their house. They were in retirement, and they, because their portfolio went down 15%. Yeah. So my argument to that is you should not have been invested that way. Because if a 10% correction means you got to sell your house in retirement, you shouldn't have been. You're not allocated properly, right? It kind of reminds me of people, younger people when they live paycheck to paycheck. Mm-hmm. When they ask them, hey, do you have enough money to survive a 6-month economic downturn? No, I don't. Well, you should maybe ask the same question as a retiree. Hey, are you allocated in a way that losing 10% potentially of your equity exposure is going to make you sell your house or do something drastic? Right. I think, but let's face it, the media and they don't really make a lot of money on good news does not sell. No, it doesn't. So. We wouldn't pay attention to it. So during the State of the Economy, I always get worried. We've been doing these we just held our 10th annual one. But election cycles, when it's an election year, I always get nervous doing these because no matter what we do as advisors or an economist like yourself, when a new administration comes in, you're looking for where's opportunity. And when we stand on stage or when we talk to people, we're trying to express, hey, with Trump coming into office, this is where we think sectors or where things are headed to invest. Nowadays, lots of times, if that's not your party or you hate Trump, it's spun on you that you must like Trump because we're trying to explain people. We manage money. We're looking at the good side of things of where to invest and what are the good things about the administration, right? And same under Biden. When Biden came in, we had economists and people talk about, hey, where do we think opportunities are then? And then the other side is hey, well, they must like Biden. And I want all of our clients to know we try to stay neutral with what we're doing. We try to find good things under each administration, under each different classification of policies of what they're trying to do, of where should we run with our money, how should we invest that, and what are the best places, trying to forward look of what the administrations are doing. Now, this administration's come in hot and heavy fast, right? Doing a lot of cuts, fraud, waste, abuse, cutting the size of the government, trying to get our debt under control. Basically, things have ballooned astronomically, and it's time for the government to get their crap together, right? Let's face it. So they're trying to do that. But I think this whole tariff thing, depending on what news channel you watch of how it's spun, between whether it's Fox News to CNN or whatever wherever you guys get your news, it's spun as a good thing or a bad thing. So what are your views and opinions of what this administration is doing with these tariffs, and what do you think the long game is here? Yeah, so I can see both sides of it, right? The tariff thing, listen, if someone's charging you a higher tariff, and you're taking it, right? I mean, I can see the fairness aspect of it. It's like, why are you charging me 50% and I only charge you 10? Right. I understand that tariffs exist for what reason? They exist because, countries that want to protect certain industries within their country don't want them to get crushed by a bigger player, right? Right. I don't really consider Canada or the EU or even Mexico to be, underprivileged, small countries that don't have mature industries. So I could see the whole fairness aspect of it. The interesting thing about the tariffs is that, don't forget, just like any business cost. It's an input cost to the business, right? Smart people run these companies, okay? And if they're not automatically blanket going to raise your tariffs by whatever tariff we decide to put on them, right? So if I'm running a company from the EU that's getting hit with a 25% tariff from the Trump administration, you know, you've got energy costs, you got personnel costs, you've got facilities costs, you got materials costs. There's all these other costs that go in there. So tariffs become an input cost. And then on top of that, you've got a profit margin. So there's any number of places where you can make adjustments to your business model and really probably not even pass the price on to the end consumer. But it's so much easier to say, Trump slapped a tariff on this country or on this group of countries, and everything that you buy from there is going to go up 30%. It's fear mongering, right? At the end of the day, I hear a lot of may with this stuff, but I've yet to see anyone who said, I've been directly impacted by these tariffs, and I'm hurting. What our people are hurting by is the fact that, you know, prices went up 20% than they were 4 years ago, and those things aren't going down. And they're just increasing a little bit less than they were in the past. So inflation's a bad thing. At the end of the day, I'm in the camp of like, I just want to wait and see. And if I see bad happening as a result of these tariffs, I'll call it out. I'll say, look, this did not go well. But people that vote with their sort of allocations, their politics with their allocation, that's not a good way to do it. I mean, when you think about it, you know, again, 3/4 of the time, market's going to be up. Well, guess what? About 50% of the time, your guy is in office or is not. So there's the potential for you to make a mistake there. The other thing is, you know, the hot trend that had been going on for a few years was socially responsible investing. Those have done really horribly. So to me, it's like, listen, the way I look at it is the market, you know, put your money in the market. If you want to, you know, support your political causes, do it outside your portfolio. You can donate money to politicians and things that you believe in. Let your portfolio make the money, and then you do whatever you want with it, right? Or spend your free time doing that. But to me, it's foolhardy to put a filter on top of an already hard process. Because making money is hard in the markets, and being patient and not getting panicked and wanting to throw in the towel, that takes a lot of self-discipline. And then when on top of that you throw on there, you know, well, I don't like the current administration. You know, it's making a hard thing harder.
Well, and I put it this way: when I was in Europe last year and was in Italy and all over there, I didn't see a GM, I didn't see a Ford, I didn't see a Dodge. It's a bunch of European manufacturers, When I drive here, I can drive 2 miles and see a European car here, So I think what Trump's in the administration is trying to do is equal the playing field. I mean, if we're not exporting and we're not getting our goods sold over there because the tariffs are so high that nobody's buying our goods, one is he wants it to open up to help our economy and our business here be able to continue to sell and grow and help grow America. If not, then here in America, when the prices of foreign goods get high because we slap a tariff on them, then you're going to start buying more American goods because they're the lower cost item, And the idea here is like Apple, he said, hey, they're going to do $500 billion investment and bring plants from China back here and to do those things. Now, that's probably not going to happen during his administration, obviously, in the next 4 years, because that takes a lot of time, But I think ultimately, if we're America first, which I am, no matter who's in office, you know, we're both prior military. They're the commander-in-chief. You get in line with what's going on, and we can have a difference of opinion, but still talk about things and address it, So I think, hey, if that's what it's about, and it's going to develop more here in America, and these companies that have been outsourcing, basically what they've been doing is building plants in other countries to import it from the other countries to get around U.S. tariffs, So why don't we just get to an equal playing field that is equal for everyone, so that we're all growing and booming together? There shouldn't be a tit for tat,
Yeah, I think if you look at the tariffs, we're not hammering them with more. We're just matching. So that should tell you that, you know, it would be one thing if it was punitive in the sense of like, you know what, I don't like you people, you know, everything is even and everything was fine, but I'm just going to slap a 50%er on you. That's kind of punitive and that's kind of, you know, mean. But to your point, when European cars come over here and we charge like, I don't know, 5%, 12% tariff on them, but they charge a 50% tariff on our cars.
Right.
That just, it's got a smell of it being unfair.
Sure.
So, I get that, but at the same time, you have to realize that markets don't really like change. So
No.
as cockamamie as the process and the system was, the market, again, when we talk about how, a few minutes ago, we talked about how the market's going to, where's it going to go because it kind of, things have changed.
Yeah.
Well, in that cockamamie convoluted system, the market figured out, okay, tariffs this, and that. Countries are going to, export, import, slap it made in Mexico and just, all that stuff. They figured out how to make that work and make the market go up, right? So I think this new sort of regime that's in place here the market will figure that out as well. It's just going to look messy and painful. And I think the biggest probably criticism I could have is not that we're doing something that is unfair or that's something that, isn't right. It's more the fact about how we've gone about communicating it. I just think, Trump, in my opinion, has always been a horrible communicator.
Right.
He does not like he says one thing and he's already thinking about 5 things already, and he's looking at you like you got 4 heads because you're not keeping up with my telepathy.
Right.
So that's kind of the challenge. You need to almost get out there and say, listen, here's why I'm doing what I'm doing over and over again, because people need to hear that repetitiveness. And then I think more people will be on board because, people can get behind things like fairness. They can get around things like, more so an even playing field, that's for sure. And a lot of people, I think, maybe I'm biased, but most people love their country and want to do well. But by the same token, I worry that if you put too many tariffs on the foreign stuff, we're going to have bad players here who are just going to, raise it up just below.
Right.
And then, prices will go up from that standpoint because I don't like to see that. Hey, we're doing you a favor because we're driving people to your market and you're going to,
Right.
and you're not going to play.
Well, no pain, no gain in anything, right? I mean, if we're trying to get businesses to move back and do more manufacturing stuff here and doing this tariffs, there's going to be some pain in the markets to do that, right? It's just like any retiree, hey, I want to get debt-free before I go into retirement. Well, I'm going to have to make extra payments on my house and my cars to try to achieve that because I'm on limited income in retirement. Well, you're going to tighten the belt. Something's going to give. It's going to be those vacations, the extra spending, right? And so if we got to have, in my opinion, we got to have a little pain for the next phase of America to boom, then so be it, right? I mean, it's been a good ride.
Yeah.
And so we're going to have a little bit of a pullback. That's normal. Market's got to take a breath before we go into the next phase. So moving forward, what would be, with what you're seeing, sectors or areas that you think would be long-term, 3 to 5 year, I would tell anyone buying right now, if you're buying equities, you should be willing to hold for the next 3 to 5 years, right? You got to be looking out there. It's not, hey, I'm buying for the next 12 months and then I'm exiting the market. I would say if you're buying anything now, you need to be holding it for 3 to 5 years, is my opinion, right? So with the 3 to 5 year time horizon, what sectors here in America would you be looking at? Is it the energy sector?
Yeah. So personally, I'm not, as a company, Advisors doesn't really do stocks or sectors.
Right.
Personally, you have to look at where sort of the focus is right now. First off, I think technology will always do you right because we're at a point where if you can imagine something, it's gonna happen, right? And I mean, look at what happened the other day. It's like NASA couldn't get astronauts home. It's like we literally had someone who builds rockets bring astronauts home. Right. I mean, that's unheard.
Cool.
Yeah, that's unheard of, right? But but that's the strength of technology. I think there's going to be a lot of opportunity with all of this sort of AI stuff that's gonna come down just to make our lives easier. And I'm not talking about you see the creepy commercials where the house won't let you out, or the car takes you someplace you don't want to go. I mean, hopefully it's not like that. But I mean, to streamline and make us more efficient. So technology to me is always a winner. It's going to be volatile.
Yeah, it's always the one that loses the most.
It's always
in
the one that goes down,
right?
but it's also the one that gains the most, right? I think traditional energy is probably a good place. Defense. And probably if we get to the point where we start building more houses to make them more affordable and things like that, you're probably still going to start looking at the financials and the traditional ones, right?
Sure.
I think healthcare is going to be an interesting one, right? Because we are aging as a country, right? And that's become much more of a business. But if that can be more efficient, I think that's been kind of the challenge, right?
It's hard to get in anywhere to see a doctor or do anything.
It's a black hole, though, right?
Yeah.
Also, it's like the costs go in, and like a lot of people just kind of like accept what it is. And if we can make that part of it better from an efficiency standpoint, and AI can help. The thing that kills me still is like they still haven't digitized all the records.
Right.
Like, how ridiculous is that?
Right.
But anyway, yeah, I would say the things.
A private company would never be able to operate the way this government's been doing.
No, but listen, at the end of the day, I mean, if you could streamline some government spending, make it a little bit more efficient, make companies more efficient, I think those are the places, right? And I don't really think you're going to see utilities and things like that, but but I think
those are always the steady
if you could stick to the energies, the defense, the financials, and tech, I think that's just me personally. This is the way I look at it. Because I'm optimistic. I'm always thinking 3 to 5 years we're going to be higher than where I haven't been let down by that, right? I mean, I'm not I don't recall the 70s, right?
Yeah.
And really, that was the last time where we've had a prolonged dead spot. I think the difference in the S&P was something like 10 points from like 1972 to when Reagan came in, which is crazy, right? I mean, literally 10 points.
Yeah.
But and I'm surely you haven't seen a period like that in your lifetime either. So and I don't at the end of the day, I don't think we're probably going to see that in our lifetime.
Yeah.
I think the markets are going to come back. People are going to worry, and we always do.
Right.
But hopefully we're not making poor decisions. I tell folks about the power of having goals versus like I don't know what 10.9% means. Like I want you have people that'll come in and ask, I want to make 11% next year. Well, what does that mean? What does an 11% life look like versus a 9%?
Right.
But just because you're retired does not mean that you're done, right? People just don't hand you their money and they say, here, give me 9%.
Yeah.
I would kick that client out. I'd be like, listen, I can't help you. What I need from that client is I need that client to articulate what their goals are, right? Put my grandkids through college. I want to buy a home in the mountains, whatever. I want to cruise
the world.
Whatever, right? They're your goals.
Right.
You can articulate that to you and your team. And then when we have things like this, the only question you should really be asking is calling up and saying, hey, Landon, am I still on track to meet my goals? Right. Not like, am I going to get 11% or 10.8? Doesn't matter.
Right.
And if the answer is yes, you're fine. But if it's not, then that's why you plan. And then when you start getting weird about what you see on TV and they're trying to make you, emotional, you're there too to say, stop, we have a plan. We were sober when we drove this up, so don't be calling me on Saturday morning at 2 o'clock in the morning, wanting to buy like gold ingots or, bat guano extract, whatever they're trying to sell you. Right? That's the challenge, right? The challenge is staying disciplined and staying focused on the goals, right? As a retiree, you shouldn't have to learn Starbucks language.
Right.
You just want your coffee medium, all good. I don't need to know what you guys call it. Right. By the same token, you shouldn't have to call me up and tell me, well, what about this ETF? What about that mutual fund and this structure? No, you're retired. Relax.
Yeah.
So just focus on what your goals are, and then you guys implement. And then when things are, when you aren't comfortable or you're not on track, then you reassess.
Right.
But that's the only way to really be effective at this game. That's why it's called investing. You have to put the time and the effort into it. And it's not, it's not gambling.
Last topic, Fed, interest rates. Trump wants lower rates. Jerome Powell doesn't look like he's willing to reduce them still. I'm kind of in the camp as I don't see a reason to reduce, right? They've already reduced a point. We're basically at 4.5 on the Fed rate, down from 5.5. We were getting 5% on money markets. Now they're down to 4. Fed has kind of talked maybe 1 to 2 rating decreases this year. Trump wants more because that spurs the economy. Lots of younger families can't afford a home at the pricing today and interest rate cycles. So that helps spurs the economy. But I feel like the Fed is like, hey, we want to keep it healthy. I think the Fed needs to get out of the game and stop screwing around with things, right? And to me, it's like that's their last-ditch effort with all the quantitative easing and bond purchasing that they've done on the Fed balance sheet right now. Their last play in a downturn or a recession is to reduce interest rates to help us get out of it, right? So I feel like Jerome Powell's holding that close to his chest, waiting to see, whereas Trump wants them down because it helps spurs the growth and everything in the economy. What's your opinion or thoughts on?
I mean, listen, I think where rates are right now is a more natural place, and I agree with you. You have to have enough powder if we do hit an economic downturn. So I like where we are right now. I think, any politician that wants to spur growth is always going to, hammer on the Fed to lower rates. But in my view, I think that could be irresponsible because that's, cheap money will generate bubbles, and you don't want that, right? I feel bad for younger folks, but I also remember a time when my dad took out a mortgage and it was like 14%.
Right.
Okay.
The home was 50 grand, not 500.
Yeah, but 50 grand in 1975 was a lot of money, right? So and so, to me it's like, we live in this day and age where everything needs to happen tomorrow, everything needs to happen today, I need my delivery in 2 days. Maybe it's not a bad thing that people learn a little bit of self-discipline and saving and sacrifice. And yeah, I get it. It's expensive to buy a $500,000 home and pay 6%, but 6.8% or whatever 30-year mortgages are, that's a pretty normal, traditional rate, right? Now, but the hope is that if the administration can, get the home builders back, because think about this, you live in a place here where, that got hammered in 2008. A lot of homes got built, and then there was a lot of vacant homes. You can go around and buy a house for nothing. And then but what did that teach the builders? Like, don't overbuild.
That's right.
Just be really, really stingy about how much you build, and that led to this housing shortage. So if we can reinvigorate the housing market, I don't know that homes are kind of weird because nobody likes to take less for their home, right? If once they see a number, right? But housing prices may at least mitigate, and then youngsters can get in and get a decent house. But yeah, I don't think interest rates really need to go anywhere. We're still at 2.8% inflation. That's significant, right? And I mean, we need to get that down. But if you cut rates right now, all that's going to do is at best keep it at 2.8%. It may even spike it back over 3. So to me, I think we're okay. Let's just see how things pan out in the next 6 months or so. With the tariff stuff and maybe the stuff. Maybe the government can be a little bit more efficient, get rid of some regulations, lower energy costs, price of eggs, man. I don't know what's going on with eggs, but the chickens are back.
It's right.
It's
just in time for Easter.
Exactly. We need those eggs. So I'm just kind of want to chill here for a little bit and see how things play out. I don't think the time is right now to just throw in the towel or go all in either.
And I've heard a couple. Last thing is like, could you explain? I think we're going to get to a point maybe after this quarter, GDP may be flat. Maybe it is going to be a little negative. I think it's still too early to know yet, right? But stagflation. When I've heard a couple of economists saying, "Hey, concerned about stagflation." Thoughts, opinions, views on that?
Yeah. So stagflation means you have prolonged periods of elevated inflation and little to no growth, right? The hope is, I think a big government and where we were going with government spending and government creating jobs, that was, to me, the surefire path to stagflation. Again, I'll go back to the fact that if you spur business, bring businesses back, lower regulations, cheaper energy costs, all the things that we talked about, that's going to create growth. And that way, and then if you don't have the drag of government, right, or you're not raising taxes, all those things that are not productive, they're going to go into the means of production, and then you're going to have that growth. So I don't really see the current policy stacking up as stagflationary. The challenge is going to be trying to avoid a recession in the near term because people are being scared. Right? They're being told tariffs are going to, cause a recession, and no more government spending is going to cause a recession, and we can we can beat our gums into a recession, and that's kind of what we have to avoid, that psychological pitfall.
Right.
So.
Well, under the last administration, we had 2 negative quarters, which defined a recession, but they wouldn't call it a recession. I feel like they'll be calling this one a recession after 1 negative quarter.
Well, and remember, we talked about why this is potentially going to be a negative read, right? Is if you look at how GDP is calculated, it's all the means of production that we have here minus the stuff we import. Well, because the tariffs were telegraphed, a lot of people imported a lot more. Now, our one side of the equation didn't go up, but the other side did. So if the thing you subtract out is bigger,
right,
it's going to push you off a cliff.
Sure.
So I think just a lot of people pre-bought stuff, trying to avoid the tariffs, and that created that imbalance. So
right,
it might be an artificial reading, but we're 1 foot in the door with that one, right? So it doesn't take a big misstep to go all in, and then we do have the 2 quarters, and you're right, they'll call it a recession, even if it only lasts, a quarter and a half.
Sure, sure.
Okay.
Well, I really appreciate you taking the time, stopping in the office, giving us an opportunity to get your views and opinions about things, maybe help calm some nerves of some clients, show where we think opportunities, things that we could practice and implement right now. So,
hey,
really appreciate it, Tom.
Good seeing you. Thank you very much.
Safe travels home, bud.
Thank you.
Thank
Take
you.
care.